Hey, everybody. Thanks for joining us today. And again, as always, I got to come up with some other tagline. We have a really incredible guest. I don't do this on a regular, weekly basis, but I do it when I meet somebody who's interesting, that I feel has a valuable message and maybe some knowledge to pass on to everybody. If you remember, or I don't know, maybe this is the first video you're watching, but I don't know, maybe about a month ago, I interviewed a gentleman and his partner that were in the business of helping seniors transition either from a home and maybe they were downsizing, or a home into long-term care. And, as we get older, I'm 63 now. I think I'm fairly sharp still. I don't know if I'm going to feel that way 10 years from now. And the gentleman that I'm talking about, his name is Steve Shapiro. He is with he has a, I don't know if you would call it a company, but he has a business called LTC Santa Cruz. And Steve has got a rich history that leads up into what we're going to be talking about today, which is preparing for retirement and long-term care. He's a really, really knowledgeable guy. And considering a lot of my clients, have been with me for a long time. They have loved ones that are getting into retirement age. And then also we have, the baby boomers that are starting to explode right now. I just thought, this is a perfect time to introduce somebody like Steve. So with that said, please, before we get started, don't forget to like, subscribe, hit that bell. Let's go. Hey, Steve.
Good morning, Barry. How you doing?
Morning. I'm doing well, sir. Thank you so much for joining us today. And, I think you were behind the scenes there. You heard kind of my introduction about you. And, there's many facets. I see us doing this more than once because you have such a rich background. But without me taking up too much time, why don't we just ask you, what is your history? What have you done in your career, Steve? And what led you to this point?
Yeah, thanks again, Barry. So, hi, everybody. Happy to be with you today. So, 30-second commercial on my background. I'm a certified financial planner, certified in long-term care, former CPA, been helping people plan for retirement and such since about 1990. Today we're going to talk, of course, about planning for retirement and long-term care, but I was thinking about my background and what led me to this point. And I remembered something that I hadn't really thought about much for many, many years. And that was that my first contact or exposure with someone who needed care was in my own house. I was, I think 12 or 13. My grandmother, my mom's mom, had a stroke, which incapacitated her on one of her sides. So she moved in with us. And I remember distinctly now, helping her in and out of her wheelchair, helping her in and out of the bathroom, in and out of bed, helping her with meals and such. So I hadn't thought about that in a long time until I got into helping folks with retirement. And actually, my first client, long-term care client, was in 1991. Recently retired PG&E lineman, and he purchased a policy. Fast forward 20 years, he ended up using it for 3 or 4 years. Then he passed on, but he made the investment and to protect his family, and that's exactly what happened.
Yeah, I also took care of my mom for the last 6 years of her life, Steve. And my mom wound up, believe it or not, passing away on her 70th birthday. I was taking her to the airport and she tripped on a crack in the cement, even though she had my arm, and she was so frail that even though she went down very lightly, she broke her hip and then wound up dying of a blood clot about 7 days after that. I understand now it's a very common, when you break a major bone like that as an adult. But before she passed, she had fell down and broken her arm in 6 places. And I literally had to, feed her, bathe her, help her use the restroom. We took all of it on ourselves. We didn't have a nurse or anything like that came in. One of the hardest things I ever went through, but is also one of the more, I'm very grateful for having gone through that, because I was able to help my mom. But, if she didn't pass away after 7 days, her recovery I would have never been able to do it. She would have needed long-term health care. And I think younger people out there, I'll speak for myself, 40 years ago, I thought I was 10 feet tall and bulletproof, and I just couldn't imagine myself ever needing that kind of care. So I think the majority of people are woefully underinformed and not prepared. So can you explain to everybody what the difference is with long-term care and, let's say, medical care?
Sure, absolutely. Good question. So most of us are familiar with medical care, medical insurance. During our working years, most of us have coverage through our employer. Once we've reached the Medicare age of 65, then Medicare kicks in, and most of us have a supplement to go along with the Medicare. So, Barry, the main difference is that if we need care that is medically necessary, we have an accident, we hurt ourselves, we get sick, we need an operation, we're hospitalized. Typically, our medical insurance or Medicare steps in and hopefully helps us cover a large portion of that expense. And the key is that that assistance is medically necessary. Now, there comes a point in many of our lives where either due to an accident, such as what your mom incurred, or my mom, an accident, an illness, or simply just aging, there comes a time for many of us that we just need help. And sometimes that help is getting dressed, getting in and out of bed, taking a bath, eating and feeding ourselves. This type of help is, we used to call convalescent care, and it is not covered by medical insurance, nor is it covered by Medicare. So for the half of us, statistically, half of Americans will need some amount of care during their lifetimes. And for those folks, it can be very expensive, of course, and they either have to pay for it themselves or use investments, sell investments, etc., or many people purchase long-term care insurance because it is a rather expensive risk, to transfer that risk to the insurance company. And if we do have an impairment, then the insurance steps in and helps us cover a lot of the costs. But the main answer to your question, Barry, is it's the line that's drawn between care that's medically necessary and care that's basically more for our assistance and our maintenance, that technically is not medically necessary.
So why is it important to have the extended maintenance?
Well, as I mentioned, statistically, 1 out of every 2 of us will require some amount of care during our lifetimes. In my family, I mentioned to you that my grandmother was my first experience when I was a teenager. Subsequent to that, many years later, my mother needed care at the end of her life. I was fortunate because I had 3 siblings who lived close to my mom, and they were able to drop in on her. And at the end of her life, she was in a nursing home. And my mother-in-law, she needed long-term care. And she also spent some time in a nursing home at the end of her life. But to answer your question, Barry, why it's so important, it's important because, for many of us who are retired, one of our main concerns is, will we live, or will our money last as long as we do? In other words, running out of money is a serious concern for many retirees. We're all living longer. Generally, that's a good thing, but along with living longer comes the probability that at some point we'll need assistance. It might be because of, as I mentioned, an accident, an illness, or simply just aging. And for those of us that do need care, as many of your viewers, I'm sure, know, the care can be quite expensive. If the care is provided in our homes, that can, in California, that can easily run $5,000 or $6,000 a month. Assisted living, same amount, maybe a little bit more. Nursing home, of course, quite expensive, $10,000 and more. So when you start talking about costs of that magnitude, you can see that it wouldn't take long to deplete a person's nest egg. It can happen within a matter of a couple of years. So running out of money is a serious risk. And so planning for that risk is very important. Now, let me say, that doesn't mean that everybody needs to purchase long-term care insurance. The important thing that we should all be mindful of, and this is true whether we're retired, whether we're approaching retirement, whatever the situation, the critical thing is that we have a plan. We ask ourselves and we ask our loved ones, how are we going to handle it if I, my wife, if mom or dad need long-term care? We hope it doesn't happen, but we know that there's a 50-50 chance that it will. The question is, within the family, I think parents and adult children should discuss this. What is our plan? Perhaps we have enough of a nest egg that we can just pay for it. It's not a problem. Now, that's not true for most of us, but for some people it is. And so they're able to self-fund. They can just pay for it themselves. It's so expensive, most people can't afford that. So what other options might be available in a plan? Well, some people might have a significant investment portfolio, and their plan is to just start liquidating the stocks and the bonds and the mutual funds and then pay for it. Okay, that could work. There are tax implications of that, but the point is, it's an option to liquidate investments. What if somebody is fortunate enough that they purchased a bunch of property as they were in their working years, and they had the foresight to invest in rental properties, and they own a number of rental properties, and their plan might be, okay, if I get sick, I'll sell a property or two and we'll pay for it. Okay, that's an option. Again, there are tax implications, so it requires a conversation with the tax and financial advisors, but it's an option. Now, for many people, if they
go ahead.
Those options, long-term care insurance is one option that will step in if necessary. And another alternative, by the way, I'll mention, because I know this is near and dear to your heart, in many cases, a very viable option is a reverse mortgage. It can, when it's used properly, it can be an excellent planning tool. But the main point, just to to reiterate, is to have a plan. What are we going to do as a family if mom or dad needs long-term care?
Right. Well, interesting. You said a lot there then, and a lot of it I 100% agree with, and some of it I really didn't even think about. But like one of the things that you said that I actually just did a presentation on with the reverse mortgage is that 72% of Americans don't have enough money saved to be able to fund their retirement past 10 years. And this is only assuming a $55,000 a year cost in retirement. So, I mean, if you live in Hoboken or in a major city, you know, it may be more if Los Angeles, but if you live in, you know, I don't know, in the Midwest somewhere, in Minnesota, you know, 55,000 might be able to get you a long way. But yeah, 72% of Americans are not financially prepared to live beyond 10 years in their retirement years. And and as you pointed out, Steve, when you and I were talking, I had told you about this strategy that, you know, about, you know, most people, their life savings is wrapped into their home.
Yes.
They might, if you're lucky, you know, if you're one of the fortunate few that have money in the stock market, 401ks. I mean, I have clients that were super high level professionals, you know, at Google, and, you know, they have a couple $1 million, you know, but they were making $750,000 a year prior to retirement. And, you know, so, this idea that we could have a home that is paid off, and, you know, a senior always says, well, I want to leave this for my kids. Well, when you get a reverse mortgage, you're still leaving the house for your kids. You're just able to tap into that equity that you have into the home much easier. As a senior, most seniors can't do a home equity line of credit, or they can't refinance because their top earning years are behind them now. Now they have Social Security, maybe a small pension. So the reverse mortgage is perfect. And the idea was, well, let's take a monthly payment for a whole life policy, and you can get a whole life policy if you qualify, and then leave your loved ones your home and leave them, you know, let's say a death benefit of $700,000 or $800,000 that is non-taxable. And you're the one that brought up to me and said, well, you know, you could do the same thing with a long-term care policy. And there you go. I mean, another light bulb went off in my head. I'm like, my gosh, you're right. Like, most people don't want to go into a nursing home. You know, right. I guarantee you, even the ones that are there probably don't want to be there.
Right.
People want to age in place. And the beautiful thing about the reverse mortgage is that as long as you're living there, you can tap into that equity to help cover a lot of these expenses later on in life. There's a lot of other benefits to it, but, you know, I love your idea about being able to, without much effort at all. I mean, if you're out there and you think you can't afford a policy like what Steve is talking about, but you've got $900,000 or $800,000 or $700,000 in equity that is literally just sitting there, and you don't have any kind of a backup plan, my gosh, what a great idea this is. So let's talk about that for a second, Steve. Like, how does it, you know, if somebody does want to take advantage of, you know, getting a long-term care policy, I'm sure it has to do with their age and their medical conditions and how much, but give us an idea of what that costs in the process, if you don't mind.
Sure. Happy to do that. But let me back up for just 1 second and comment on something that you said also, Barry, because you're absolutely right. You said that, you know, most of us, of course, given a choice, would like to age in place. We don't want to go to a nursing home. Right. There's a misconception. There are many misconceptions when it comes to long-term care and long-term care insurance. One of them is when someone hears long-term care, the first thing they often think of is nursing home, when in fact, that is not the case. Long-term care is not a place. Long-term care is an event, something that happens such as what happened to your mom, my mom. It's an event, and it's nearly universal, of course, that if we need care, we want to have that care offered. We want to receive it in our own homes, and of course, with a reverse mortgage, you are in the home. Long-term care insurance will cover your care, regardless of where you need it, whether you need it at home, in assisted living, or as a last resort, in a nursing home. So I just wanted to.
And touch on your point too. I mean, it's not just the seniors. I mean, how many of us that love our mom and dad, or our uncle or whoever it might be, and we're scared to death of somebody that we don't know who could possibly be abusing our loved one in a senior care facility, whether it's imaginary or not. We've all heard the horror stories. We do know that when this last, pandemic hit, that that was one of the first places it was really spreading like wildfire, because you have so many people in confined spaces. So I love the fact that you put an exclamation point and underline this, that long-term care does not mean going to live in a senior care facility. It is, you might even have your senior or your loved one might, maybe downsize and move into a 55 or older community where they can participate in community events, and then still have that long-term care benefit where it's paying for somebody to come make sure that they're taking their pills on time and cooking for them and making sure that, their daily needs are being met. Right.
Exactly.
Yeah, I love that, Steve.
Yep. And Barry, just to put a bow on that, and that conversation, the reality is over 80% of the people in the U.S. today receiving care are receiving that care in their homes. And it makes perfect sense, because that's where we all want to be. And to your point a moment ago, Barry, that it's not just older people that have to be concerned about this. Now, I mean, yes, it tends to affect more older people than younger people. But my best friend from childhood was permanently disabled in an accident at age 30.
Wow.
And I had a client who, unfortunately, suffered with early onset Alzheimer's at 55. Now he didn't have insurance at 55, so his family, out of his resources, they paid for his care for a couple of years, and then he did pass away. But an accident can happen to any of us at any time. That doesn't mean that we should all buy long-term care insurance when we're young. No, not at all. Truth be told, the ideal time to look into, to review this risk with your family and determine whether long-term care insurance might be appropriate, the ideal time to apply for a policy is between the ages of 50 and 64. Why do I say 64? Because once we go on Medicare, we tend to visit our doctors more often. When you visit your doctor more often, there's going to be more notes in your chart. There's going to be more of an opportunity, more of a chance that the insurance company will see something in your chart that they perceive as a negative, which may affect your ability to purchase the insurance. At 50, most of us are young, active, healthy, insurable, in our peak earning years, and we can afford the long-term care insurance. So, 50 or 55 to 64, that's the ideal time to be looking at it. My wife and I purchased it when we were both the same age. We purchased it when we were 57. So we were right in there.
Sorry, Steve, go ahead.
No worries. Let me get back to your original question, Barry, because we were talking about reverse mortgages and staying in the home.
Yep.
And you asked about, well, how does it work if someone, wants to consider the insurance? What are their options? How does that work?
Mhm.
So let me just real quick, explain to folks the basics on the couple of main options that are available for purchase of long-term care insurance. And there are two primary ways to get this done. The first type of insurance that's available for long-term care is what's often called a traditional long-term care policy. It's very straightforward. It operates just the same way that our auto insurance, our homeowners insurance, same way they work. You pay a premium, you have coverage. It's that simple. If you, most of us have had auto insurance for forever, of course. Homeowners insurance, if we're fortunate enough to own a home, we pay the premiums year after year after year. We hope that we never have a claim, and fortunately, in most cases, that is true. We pay the premiums, we don't make any claims, but we were protected. Long-term care insurance is the same. Many people, one of the excuses or the rationales they tell themselves as to why they don't purchase or don't want to purchase long-term care insurance. Well, I don't think I'm going to need it. I don't think it's going to happen to me. Well, it's going to happen to one out of every two of us. Some say, well, my spouse will take care of me, my kids will take care of me. In any case, they say, I don't want to spend the money on premiums for something that I'm not sure I'm ever going to use. Okay, I get that. I don't either. But the point is, I do it with my auto insurance, I do it with my homeowners insurance, and yes, I do it with my long-term care insurance because I have seen the effect of not having long-term care insurance in my family as well as with my clients. So that's why it's so important to protect against the risk. So I started off by saying there's two options for basically purchasing long-term care insurance. The first I just described to you, a traditional long-term care policy. Now, a few moments ago, Barry, you mentioned the concept of purchasing a whole life insurance policy as part of a plan. It turns out that there is a way to purchase long-term care protection, very good long-term care protection, and also as part of a plan that involves a life insurance policy. Now, the way those programs work, the person, the owner of the policy, has excellent long-term care benefits should they ever need it. But since it's part of a life insurance program, if they never have to draw on the long-term care portion of the policy, the life insurance proceeds goes to their heirs income tax free. So they have the comfort level of knowing that if I never need this policy for my care, my kids will receive the benefit. I will not have wasted my premium dollars. So many people who have the financial wherewithal, that is, they can afford to invest a lump sum or a significant amount of money, say over 10 years, a lesser amount of money, but over 10 years, pardon me, they have the ability to protect themselves against long-term care and leave that pot of money to their kids should they never need it. In fact, many of the people that I talk to who have a nest egg of $1 million, $2 million, they have enough of a nest egg, whether it's in their personal accounts or in their retirement accounts. They have enough of a nest egg that they can transfer $100,000, $200,000 from one bucket to the other bucket without affecting their income, without affecting their lifestyle. It's more or less extra money that they really don't need to to pay their expenses. They're likely planning to just leave it to their kids anyway. So what they say is, look, since it's extra money and it's kind of earmarked for long-term care, why don't we transfer it to this life insurance program? That way, I've got good protection, and I know that my kids will benefit if I don't use it. So those are two primary ways that people can purchase long-term care insurance.
Now, what happens, Steve, if they do, I assume that the type of policy you're talking about is the whole life policy that I mentioned earlier, where, the first 10 years of this is really a tremendous benefit to the senior, because let's say it's costing you $30,000 a year, and for the first 10 years, it might cost you $300,000, but your death benefit is $800,000. So if something were to happen to you in those first 10 years, it's a windfall for your family for sure, right? But after 10 years, it becomes more expensive. It just becomes less of a windfall, but you also have cash benefit, right? So as you get older, yes, you have that death benefit, but you can also tap into a portion of your whole life policy into the cash portion of it. And is this what you're talking about, like that you could draw on for the long-term care portion, or is this a different policy entirely?
Yeah, that's a really good question, Barry. And without getting too much into the weeds here, what you're describing is a whole life policy. Perhaps it has a rider for long-term care. Perhaps it doesn't. It's just a life insurance policy.
Okay.
So that's a little different than what I'm talking about, because the types of policies I'm referring to, the primary objective and the way it's built is for long-term care benefits. The life insurance component is really a secondary benefit. So these are purchased, these are called hybrid policies, where the long-term care benefit is the primary goal, and the life insurance benefit is a desired benefit that is offered should it be appropriate. But getting back to some numbers, since you were throwing out perhaps $30,000 a year for 10 years, these are realistic numbers for whole life policies with significant cash values. The type of policy that I'm referring to, the hybrid plan, since the main focus is long-term care and the life insurance is a side benefit, yes, there is a cash value component, but it is not the focus. It is not the primary concern. So unlike a whole life policy, which can build a significant cash value, these have a cash value. It doesn't grow very much over time. Again, the main concern is long-term care. So what happens is this: the long-term care benefit, we often index it for inflation. So in other words, if someone purchases a long-term care policy with a $5,000 a month benefit when they're, say, 65, now chances are they're not going to need that policy until they're 85, plus or minus. So we build inflation into that policy so that the benefit grows over that 20-year period from $5,000 a month to probably almost $10,000 a month.
Wow.
And so if the person needs care at any point after the policy is in place, they will receive the guaranteed monthly benefit for the guaranteed number of years that they purchased. In other words, they're purchasing a pool of money. Let me give you an example. Let's say that someone transfers, and I'll just use really round numbers, just a quick and dirty example. Let's say that someone roughly age 60, 65 transfers $100,000 from one of their other accounts into, and again, whether that's a personal account or a retirement account, into one of these programs. So they've transferred in $100,000. The life insurance benefit, day one, is probably going to be, depending on their age and their health, 125,000, 150,000. That's the life insurance death benefit. But here's the thing. We're not doing it for the life insurance. We're doing it for the long-term care. They would immediately, day one, have a pool of money available for long-term care that's probably 250, 300, 350,000 or more. Day one, they've got that pool of money available. In other words, they've just leveraged $100,000 into $300,000 immediately. And over time, that benefit, that $300,000 pool of money that's available for long-term care, with inflation, that pool of money grows over time so that by the time they might need it, it's grown to be a much greater pool of money. So that's basically how the hybrid type of long-term care insurance works. And the reality is, of the people that I meet with and talk to, if they have the wherewithal, they have the either the savings, either personally or in retirement, to be able to afford a plan like this, 8 out of 10 people choose it because it's just it serves both of those purposes that are important to them.
What happens to those people that don't have $100,000 to get a policy like this started? Is there like a monthly way to be able to set it up and then pay monthly? How does that work? And with that said, we're running up against the clock. Answer that question, and then also answer, what is the most important thing you'd like our viewers to take away today?
Sure thing, Barry. Thank you. So the answer to your first question is yes. Obviously, not everyone can afford, $10,000 a year or $15,000 a year for 10 years, or a $100,000 investment all at one time. For those folks, and that's the majority of people, the way that they could solve this problem would be to consider a traditional long-term care policy, because those you can purchase and you can pay the premiums monthly. You can pay the premiums annually. It's your choice. So that's a great question. And the reality is that is the way most people purchase it, is by paying monthly. So thanks for asking that.
Yeah.
Now,
what's the most important takeaway here?
Yeah, I mentioned it earlier. The single most important message that I would like your viewers to take away from our talk today is that the most important thing is to talk with your spouse, talk with your adult children about the possibility that you might become impaired at some point, and discuss, what is our plan? How are we going to handle this? Do we have the resources to handle it? Should we really be looking into long-term care insurance? What about a reverse mortgage? Might that be a possibility? The main thing is, it's not that everybody needs long-term care insurance, but my advice is everybody should discuss it. Everybody should have a plan for how they are going to handle it should the unforeseen impairment take place.
Yeah, and I don't want to end this on, like a down note or to try and scare anybody. I just want to try and lay some reality on everybody. Like I told you, and Steve told you, we were fortunate enough to take care of our family. It was one of the hardest things I ever went through. And honestly, I think I got away lucky. I didn't want my mom to pass away, but the way that it all worked out, if she would have not passed away, she would have been in for the rest of her life into some sort of a rehab, and it would have been incredibly painful, frustrating. And what's worse on it is, I know I have, clients and friends whose parents have had Alzheimer's and, Parkinson's, and, it's easy for you to say, well, I have my family to take care of me, because you're not the one doing the taking care of. I know people that have gone through this, and they almost have PTSD. I mean, it is such a massive heartbreak for them the taking care of your loved ones is very, very difficult, but watching them decline and not having control and being, not being able, you can wish it away, you could pray it away, you can, look for alternative medications and therapies that could help ease that person's suffering. But the emotional anguish that your loved ones have to go through all the while they're trying to take care of you is not something you want to do to your family if you can avoid it. My wife is Filipino, and that's in their culture. I mean, they have many children, and their whole deal is that they're there to take care of the family, their parents, when that day comes. So
Right.
it's not like it can't be done. It can. But if you have the ability to try and help your loved ones by getting this type of insurance, trying to think ahead a little bit, it's going to make your life better, and it's going to make your loved one's life easier. So, Steve, this has gone longer than the majority of my interviews. And the reason why is that it's just, such a great service that you're bringing to awareness here. I don't think there was a second of this that I didn't enjoy listening to. So thank you so much for coming on here. We'll have to do this again sometime because, I know that you do other things to help people as well, but, is there any last thing you'd like to leave with everybody as we go?
No, I just want to thank you, Barry, for giving me the opportunity, and just wish everybody the best.
Awesome. Well, folks, if this doesn't apply to you, or maybe it does apply to you, if you got value out of this and you know somebody that could really use this information, please pass it on to them, forward the video, subscribe, like, and hit the bell, and whatever you can do to support Steve. And by the way, and to support us, but Steve's information is below on the scroll there. If you want to message us, through social media, you can do that. Or if you want to just, send Steve an email or call him, very affable guy. If you haven't figured this out yet, I've never felt any kind of weirdness or pressure with him. I genuinely think that Steve is coming from a really good place, and that's the kind of people I like to surround myself with. So thank you so much for doing this with me, Steve. And I hope everybody gets something out of this, and thanks for watching.